All right, let's jump right in. Today, we're going to demystify something that's absolutely fundamental to our financial world, but it's often a bit misunderstood. We're talking about the financial audit. Now, it might sound super complex, but really, at its core, it's all about one simple thing: trust. So let's get into it.
Just think about it for a second. When you look at a company's financials, whether you're thinking about investing or maybe you're a lender, or even just curious, how do you really know that the story those numbers are telling is the truth? That's the big question, right? And the answer, for the most part, lies in the financial audit.
So to really get a handle on this, here's our game plan. We're going to walk through these 6 key areas. We'll start with why audits even matter, then nail down what one actually is, meet the key players, take a peek inside the process, see the real-world benefits, and then finally, figure out how to choose the right level of scrutiny for any organization.
Okay, let's start with that bedrock idea, the foundation of trust. Our entire financial system, from Wall Street all the way down to your local credit union, it all runs on confidence. But where does that confidence actually come from? It's got to be built on something solid, right? It's built on a system of verification.
And a huge piece of that puzzle? You guessed it, the financial audit. This is not some newfangled idea. It's a process that's been tested and refined for ages. It's been a cornerstone of financial integrity for a long, long time, and it was designed specifically to build that confidence among literally everyone with a stake in a company's performance.
So that brings us right to the main event. What exactly is a financial audit? Let's break down what it really means.
Put simply, it's a professional checkup on a company's financial records. Now, the 2 words you've really got to latch onto here are independent and opinion on fairness. The auditor is an outside expert, a neutral third party who comes in to give an impartial verdict on the numbers.
Now listen closely to the language here. Auditors give reasonable assurance, which is not the same as an absolute 100% guarantee. What it means is they've done their homework, they've dug deep enough to be confident, but they can't possibly check every single transaction. Their goal is to confirm that the financial statements give a true and fair view. In other words, is this an accurate picture of the company's financial health without any major errors?
And who is this all for? Well, it's for a whole lot of different people and organizations. Shareholders, obviously, want to know their investment is safe. The government needs to make sure taxes are being paid correctly. And banks, they definitely need to know if a company is a good bet to pay back a loan. Audits provide that crucial layer of confidence for every single one of them.
Now, to really get this, you have to understand who the main players are and what their specific jobs are. This separation of duties is absolutely critical. It's what makes the whole process independent and trustworthy.
Here's the big difference, and it's super important. Management is responsible for preparing the financial statements. Think of them as the author writing the company's financial story. The auditor, on the other hand, is kind of like a book critic. Their job isn't to write the story, but to investigate it and then tell everyone else whether they think that story is a true and fair reflection of reality.
Okay, so we know the what and the who. Now let's pull back the curtain on the how. What does an auditor actually do day to day?
So the auditor's whole mission is to hunt for something called a material misstatement. Now, that sounds jargony, but it's a simple idea. We're not talking about a $5 rounding error. A misstatement is material if it's big enough that it could actually change the decisions of someone who's relying on those financial statements. It's a game-changing error. The whole process usually follows 4 main stages. It all starts with a ton of careful planning. Then comes the real deep dive, what they call substantive testing. That's where they gather all the evidence. Based on everything they find, the auditor forms their professional opinion. And finally, that opinion gets published in the official auditor's report for the world to see.
Let's zoom in on that second step, substantive testing, because this is where the real detective work happens. Auditors don't just take management's word for things. No way. They gather their own proof by analyzing data, physically inspecting documents, watching procedures happen, and even getting direct confirmation from outside parties, like calling a company's bank to verify a balance.
And one of the most valuable things to come out of this whole rigorous process is the management letter. This is a separate confidential report that goes directly to the company's leadership. It gives them candid feedback on their internal systems, their accounting policies, and other important stuff the auditor found. It's an incredibly useful peek under the hood.
Okay, so this all brings us to the real payoff. Why would any company want to go through such an intense process? What are the actual tangible benefits of having this level of assurance?
Well, there are 4 huge ones. First, the reliability of your numbers just skyrockets. That in turn boosts your credibility with absolutely everyone, banks, investors, you name it. It also seriously reduces the risk of making expensive mistakes on things like tax filings. And, like we just said, you get that incredibly valuable, candid feedback in the management letter.
And that enhanced credibility,
It's not just a nice to have. In a lot of high-stakes situations, it's a must-have. If you're going to a bank for a big loan, or you're trying to sell your company, or maybe you're applying for government funding, having audited financial statements can literally be the difference between a yes and a no. So finally, it's really important to know that a full-blown audit isn't the only game in town. Depending on what you need, there are different levels of service. So, how do you pick the right one?
As you can see, there are basically three main levels. At the very top, you have the audit. That gives you the highest level of assurance, and it's perfect for those high-stakes moments we just talked about. A step down is a review, which is less in depth, but still gives you limited assurance. Good for, say, smaller financing needs. And at the base level, you have a compilation, which provides zero assurance. It's basically just organizing your financial data, mainly for internal use. The right choice all depends on who's going to be using the financial statements and why.
So I think the key thing to take away from all this is that choosing a level of assurance isn't just about checking a compliance box. It's a strategic decision. It's about picking the right tool to build exactly the amount of trust your organization needs to hit its goals.
And that leaves us with one final question for you to think about. Whether you're running a business, investing in one, or lending to one, just take a moment to consider the people involved. What level of confidence do your stakeholders really need to make their most important decisions? The answer to that question will tell you everything you need to know. Thanks for tuning in.